Hello everyone. In this session, we are going to talk about the classifications and the key concepts of credit risk. As a part of this session, we would be looking at the different kinds of classification of credit risk. What are the different kinds of risks that typically go as a part of credit risk? Two broad classifications is what we would be talking of. The next slide, I will highlight those various classifications of credit risk. Then, whenever we use the word credit risk, the first thing that should come to our mind is the probability of default. So, we need to have different mechanisms to understand what is meant by probability of default. How do we really compute the probability of default? So, we'll spend some time understanding that aspect. Then comes recovery. When a default occurs, it may be possible that some amount can be recovered from the borrower. So only some amount will be at risk. So that is what we are talking about, the recovery risk. What is the possibility of recovery and how much amount cannot be recovered from the borrower in case of default. So we'll spend some time to understand the recovery risk. Then exposure risk. Exposure is typically the amount that one party needs to pay to the other party. So is it possible that the exposure increases or decreases in the case of default? In which cases the exposure increases? And how can exposure itself could be an additional risk is something that we are going to look at here. Then once we have a good understanding of these different kinds of credit risks, we'll have a mechanism to compute the expected loss and what is meant by expected loss and how should I treat the expected loss in the financial statements. Then moving on to the unexpected loss, how do we really compute the unexpected loss, and based on that, how do we move forward towards the assessment of value at risk for this particular credit portfolio? And what do I really mean by concentration risk in the context of credit risk? When does the concentration risk typically arise? How does it arise? And when we are talking about the portfolio's unexpected loss, how do I really assess the contributions of each and every individual asset class or the asset to the overall portfolio's unexpected loss? So that is what we are calling as a marginal contribution. We'll talk about a formula for computing the same. And finally, we will move towards our computation of risk-adjusted pricing. We'll use a couple of mechanisms there called risk-adjusted return on capital and risk-adjusted return on risk-adjusted capital, RARORAC. So these are some of the mechanisms along with the understanding of economic capital is something that we would be discussing as a part of this particular aspect. Now let's move on to the first one, classification of the credit risk. On a broad note, the credit risk can be classified into two major headings, the default based credit risk and the value based credit risk. The default. So different kinds of credit risk that are associated with the defaulting of a counterparty. One party not paying the loan on time. The borrower not paying on time the amount that needs to be paid either in the form of interest or in the form of principal. So they are all the occasions of default associated. So there is a pure default risk where the party has actually defaulted on the commitment that needs to be made both in time, in terms of time as well as value. Then there is the recovery risk So when the default has actually occurred, whatever the amount that I am able to recover from the borrower is much lesser than the full amount that the borrower has to pay. So that is the recovery risk. Means I am getting only a part of the amount as a part of the recovery from the borrower. So that is what is how much of that money is at risk with respect to the recovery. In some cases, I may have taken a collateral under the assumption that this collateral would typically offset the possibility of loss that might crop up because of the default of the counterparty. But that collateral value may be so low, may have gone so low that its value now is nowhere sufficient to cover the amount that is due by the borrower to the lender. So all these are examples where recovery risk comes into picture. So that's one more category of default based credit risk. And we also have exposure risk. There is some possibility that at the time of default, when the person has defaulted, during that particular period, the overall amount that may have to be paid by the borrower to the seller, to the lender, is much higher than in the normal scenarios. At the time when the borrower has defaulted, at that point in time, the amount that needs to be paid appears to be much higher than the amount that needs to be paid under normal circumstances. So these are the three different kinds of credit risk that are associated with the default. And one point we need to understand is these default risks, they have very low correlation. They are almost not much correlated with the pure financial risk. When I talk about the pure financial risk, it is an interest rate risk, the losses coming because of the fluctuations in the interest rates, exchange rates, or even the inflation. So when I look at the default risk or the recovery risk or exposure risk, we see that they don't carry much of a correlation with respect to the pure financial risk. Then the next category of the credit risk is a value based, which we generally find are highly correlated with the pure financial risk, whether it is interest risk or exchange rate risk or even the inflation based risk. Within this, we see again three different kinds of risks. One, the migration risk. Here the party is not defaulting, but there is a change in the credit quality. Let's say a AAA rated issuer now has got a credit rating of A, which means there is a downgradation of the credit rating. Now that itself can impact the market value of this particular company. There is no default that has occurred, but there is a change in the market value of that particular entity. And this decrease in market value is also another resemblance of credit risk. So when we are talking about the credit risk, we are focusing not just on the default side, but even a reduction in the value because of the downgradation of the ratings. Then the other aspect that is coming up is the spread risk. See, sometimes when the economy is in a recession, right? When the economy is in a recession, it is very much possible that the investors would charge a more premium for the investments that they have done compared to when the economy is in an expansionary phase. So due to different market conditions, the investors are typically looking for different kinds of returns because they are perceiving the investments, the same investment as different levels of risk during the different market scenarios. So even because of that, the overall exposure can be either revalued or devalued. Even that is a part of the credit risk. And in some cases, just like the way we have experienced the 2008-9 financial crisis, where the markets have become very less liquid. So because of that, all the kinds of exposures to the credit risk, all the kinds of collaterals which the parties have maintained, the values of the collaterals have gone down quite drastically. All the exposures, they had to be sold at much lesser prices than the market prices, than the expected prices, resulting in a loss to the parties. So the loss occurring because of the credit liquidity risk is also a kind of a value-based credit risk, which we really need to understand. So whenever we are talking about the credit risk, we have to appreciate the fact that it can come from any of these 6 different dimensions, 3 from the default based categories and 3 from the value based category. And the ratings, the rating agencies really play a very important role in analyzing and measuring all the above credit risks that I have discussed. That's the major role of any credit rating agency. When they are offering or providing the credit rating to a particular issue or to a particular issuer, they have to consider all the aspects that we have mentioned above. Then, moving on to the next topic, where the intention is to find the probability of default. Generally, the probability of default is computed for a specific time horizon. It could be for a 1 year period or a multi-year kind of a period. So we are computing the probability of default for a particular period. And it's very important to assess the cumulative probabilities, especially when the exposures are for more than 1 year. We should be able to compute the cumulative probabilities, because we don't know, let's say after a particular point in time, this particular firm can go default, or this particular firm can get a much better credit rating, or any of these aspects. What we need to understand is, if the time horizon is very short, for that small time horizon, the probability of default may be very low. Though I cannot completely say that it will be zero, but definitely it would be very low. And as the time horizon is increasing, the probability of default also typically increases. Now, there are different approaches to compute the probability of default. One based on the historical default frequencies. I observed the default frequencies of various firms historically. So I'm first of all grouping all my borrowers into homogeneous classes, right, based on various profiles. So there are different techniques to identify the profiles of the customers, group them. Probably there is something called cluster analysis, which actually groups all the similar data together into different clusters. So these are the homogeneous classes. I'm trying to observe the historical default frequencies of the different borrowers' homogeneous classes. So one, there could be the way we are creating the classes, it could be based on a subjective analysis, or it could be through a kind of a statistical mechanism called cluster analysis. Now, if it is more and more subjective, the analytical competencies of the skilled credit officers are very much tested in the process. But this is an ex post rating class, per rating class, because once we have grouped the observations, for each of them we have tried finding out the historical default frequency, and based on that we are trying to say that for this particular class of customers or borrowers, this is the probability of default. So this is purely based on the historical mechanism. Whereas we have another mechanism, right? So this is most like ex post. So after the data is derived, we are simply trying to find out what is the proportion of those borrowers in each of the classes who have defaulted. We also have a mathematical and statistical tools which we can apply on the large databases. So various types of information that is collected regarding the borrowers is taken in the form of a score. So historically the various defaults and the various attributes are taken together. Some kind of mathematical or statistical models are being built linking the default of the customers with the various attributes by coming up with a kind of a scoring process. And based on that, for new customers, when I input in that particular score, I'm getting whether this party was going to default or not default. So this is an ex ante measure, so it can facilitate the monitoring over time. This formula can keep changing over time, and based on that, the assessment of the probability of default for each of the customers or for each of the classes at each of the time intervals can very well be computed. And in some cases it could be a combination of both judgmental and mechanical. So there is a mathematical and a statistical approach as well as a judgmental approach. So when we are talking about the classification, it is automatic. Probably I can use a cluster analysis or some such kind of mechanisms for classifying the customers. And once the automatic classification is being done, that's where the experts come into picture. Corrections are done by the experts. So they look at the various qualitative aspects, and based on that they look at both the judgmental as well as mechanical. They look at the historical as well as the statistical part, do the appropriate corrections and bring out the best possible model. And one more way in which I can look at the probability of default is purely based on the market prices. Sometimes the market prices of the securities are in such a way that corresponding, let's say if I'm talking about a particular probability of default, let's look at it in a simple way, right? So some PD is the probability of default, 1 minus PD is the probability of no default. So at the end of one period, right, there is a PD chance that there is a default. So which means when there is a default, I am only going to get the recovery amount, whereas there is a 1 minus probability of default chance that I will get my full one. So obviously at the end of the period when there is a default, the amount that I am getting is PD into recovery rate plus 1 minus PD into 1. Whereas when there is no default, I'm going to get 1. And I'm talking about the present value. 1 by e power RT or R should be same as PD into recovery rate plus 1 minus PD divided by e power R plus delta. Now based on this I should be able to calculate my delta, which is the probability of default. So I could clearly see that e power R is equal to e power R into PD into RR plus 1 minus PD is equal to e power R into e power delta. So now from here I am getting e power delta is equal to this much, and from here, so which means this, if I look at PD, so this is coming out as 1 plus PD into recovery rate minus 1, or 1 minus of PD into 1 minus recovery rate. So I could clearly see the value of delta, which is what is associated with the spread that is coming out because of the probability of default. And based on that spread, whatever is the spread, I can find out what is the probability of default associated with this particular class. So even this kind of method also can very well be engaged. So there are different ways in which I can find out the probability of default. Then comes the next aspect, which is the computation of the recovery risk. Right, the recovery rate is nothing but 1 minus of loss given default. Given that the party has defaulted, how much is the loss that is going to be there, which is obviously based on how much can be recovered from that particular party. So these two are complementary stuff. Recovery rate is 1 minus of loss given default. We express these things in percentage. And we have to understand that the recoveries are different based on the different types of credit contracts. Right? For different kinds of credit contracts, we have different kinds of recovery methods, recovery amounts, recovery processes, because the way the legal system is designed will talk about the efficiency of the recovery process. In some cases, it is dependent on the economic conditions also, because when we talk about an economy in a recessionary phase, probably the recovery percentages could be much lesser. People may not be able to pay during a recessionary phase. The borrowers, even if they are default, the recovery also could be very pathetic. But especially when the economy is doing well, then the recoveries could be much better. So even the recovery procedures could differ based on the economic conditions, and even the business sectors play an important role. In some sectors, the recoveries are much higher, whereas in some sectors the recoveries are much lower, especially associated with the asset values, the volatility that is associated with the asset values in different sectors. In some sectors, the volatility of the assets are much higher, which means their values are going to fluctuate quite drastically. Overall, the values could be much lesser. Whereas in some other economies, where in some other sectors where the volatility is much lesser, the recovery values also could be much better off. And even the recoveries are based on the various covenants that are associated, especially some kind of restrictions that are put on the borrowers by the lenders regarding the kind of actions, the do's and don'ts that the borrowers can do until the settlement of the loan. And they are a kind of privilege to the lenders. So depending on how stringent, how strong are the covenants structured in the deal, we would typically look at what amount could be recovered and what amount may not be recovered from the borrowers. So this is also these are the various things that needs to be done as a part of the recovery. How much is the will be the recovery rate if I have to assess it beforehand, assess it ex ante, then that's also a very difficult process, just like assessing the probability of default before itself. The recovery data is very difficult to collect, because majority of the times we see that the recoveries are managed at central locations at the counterparty's position. So the reference to the original contracts, because of this, the reference to original contracts, collaterals, guarantees that have been taken at the beginning of the contract, that references get lost. They are managed purely at the counterparty's position. So even if I am building very sophisticated statistical techniques to model the recovery risk, still I cannot build a lot of comprehensive capabilities into the model. That is what has been the observation with respect to the recovery risk. Then we also talk about the exposure risk, which is purely associated with the amount of risk in case of default of a particular counterparty, the amount that is at risk. See, when we are talking about instruments like term loans, etc., where we know how much one party has to pay to the other, which is a fixed kind of an amount, where we have the whole reimbursement plan for both the interest as well as principal is fully planned out fully mentioned as a part of the contract how much to be paid at what point in time. So in this case, finding out the exposure, the amount that is at risk is a very straightforward process. But when we are talking about revolving credit lines kind of stuff, where the balance, how much amount needs to be paid keeps changing at regular intervals of time, there are a lot of external events, borrowers' behaviors which would influence them. Modeling this particular aspect of the exposure risk becomes more and more complicated. So if I have to really do a quick computation of the exposure at default, we talk about, okay, how much of the loan did the borrower has already taken, amount that he has currently withdrawn or used as a part of the loan, plus whatever is the amount that is totally granted by the bank to the borrower, which is more like already discussed that he would be entitled to a credit limit of this much. Out of this, he has already used some portion of the credit limit. So let's say the bank has granted him a credit limit of 1 million. Let's say 200,000 has already been used by the borrower. So the remaining 800,000 he has the bank has already granted, but he has not used. Now, when I'm talking about the exposure at default, we are talking about 200k, which is already used, plus on the remaining 800k, we will multiply it with the loan equivalency factor. So we are talking about what is the rate of usage of this entire 800k, especially when the counterparty is very close to default. In near default scenarios, what is the kind of rate of usage of this excess limit? That is what we are calling as a loan equivalency factor. So this number would typically be used to finally arrive at the exposure at default for various revolving credit lines kind of mechanisms. And when it comes to derivatives, so the due value in the event of default, when the default occurs, how much needs to be paid by one party to the other is purely based on the market conditions of the underlying asset. So the exposure at default keeps changing at different intervals. It is it is based on market conditions and various other aspects. So we need to really focus on what are the various ways in which the exposure risk can be determined for different kinds of asset classes. So there is an assessment assumption regarding a probabilistic nature where the amount is a forecast of the future events, how much amount is at risk. It's a forecast of the future events with an intrinsically stochastic approach. We build some kind of a stochastic model to typically model the amount for the future events, and various kinds of exposure at default models are used to measure the EAD risk, right? Now, once we know different kinds of risks, now that we have already looked at what is default risk, what is exposure risk, and what is recovery risk. Now, based on that, we would be computing the expected losses. So, other definition, it's an average loss that is generated in the long run, which is typically expressed as a percentage of exposure at default. There are two major approaches to compute the expected loss. One is a financial approach, where we are talking about the loss in terms of decrease in the market values resulting from any of the 6 different forms of credit risk, which is the default risk, the exposure risk, or even the recovery risk, or even from the other aspects like the migration risk, the spread risk, or even the liquidity risk. So when we are using a financial approach, The expected loss is computed based on all these different kinds of risks, their probability of occurrence, as well as the loss that is going to occur given that scenario has occurred, and the exposure that is at default in each of the cases. So these are the three things that are taken for each of the scenarios, multiplied to obtain the expected loss. The second approach is an actuarial approach, where the losses only associated with the default, which means the first three categories are only considered while for computing the expected losses through the actuarial approach. And coming to the banks, from the bank's perspective, expected loss is a kind of an industrial cost that the lender has to face, which means this has to be taken into the financial statements of the bank. It has to be as a part of the losses that are already known. So it has to be embedded. It's a kind of a cost that they have to embed as a part of the banking business and the credit decision. So that much of loss is expected. So whatever is the portion of the loss that is expected, it has to be embedded into the overall the banking business as well as the various credit decisions that are typically taken. Whereas when it comes to unexpected losses, see, in many cases, when we talk about short time horizons, smaller time periods, the expected losses may not match with actuals. There could be a huge deviation between what is the actual loss that has occurred versus the expected. So, when we are talking about short term losses versus long term average, there could be a big deviation between them. In short term, there could be a huge amount of volatility in terms of the expected losses based on market conditions and various other aspects which we have already discussed. So there might be a lot of deviation between the short term loss versus long term average. It could be because of credit cycles, it could be because of economic scenarios or various other aspects associated. So in some cases, the actual losses may be much higher than expected. And in that case, the capability of the bank to continue on a going concern basis will be challenged quite seriously. So that is where the unexpected is coming into picture. Now, against that unexpected loss, or to mitigate that unexpected loss, or a compensation against the unexpected loss, the banks have to hold enough equity capital. In case the losses have occurred at that particular point in time, in case the actual losses are much higher, and in case the bank's survival is getting questioned, so that is against that unexpected loss, the banks are expected to hold enough capital to absorb the losses that are going to crop up during the bad times. And during good times, when they are generating higher than expected amount of profits, this is typically replenished. And when we have to talk about how much of capital do they really require as a backup, now this is where we are talking about the robust analytical risk models, because obviously whatever they have lent, they may not lose the whole amount, which might be possible only once in a blue moon kind of scenario, and there's no point in having that much of capital as a backup. So this is where how much of capital should really be required as a part of the backup needs robust analytical risk models and measures. But again, these models, they should not be restricted purely based on the credit risk alone. They have to look at the complete enterprise-wise risk, and the amount that needs to be set aside, the amount that needs to be used as a compensation should follow an enterprise risk perspective rather than a silo approach. So there should be an integrated view of the risk, not just the credit risk. And when we talk about the ratings here, they become the core. How much of the credit risk is playing, to what extent credit risk is contributing to the overall risk of the bank. The credit ratings play an important role in explaining this particular aspect. Though I have to look at the overall integrated view of the risk, the credit risk becomes a very important aspect in the process, and the credit ratings given by the rating agencies, they become very essential measures in determining to what extent credit risk is typically contributing to the overall bank risk. And we also know that for different kinds of credit ratings, let's say AAA versus AA versus B, etc., the variability of the losses is very different. For a AAA rated security, the losses variability could be much lesser, whereas for a B rated securities, the variability of the losses could be significantly higher. Now, what we need to understand here is, though as a measure of risk, we generally use the word standard deviation in many aspects as a measure of risk. For various kinds of risks, to measure the risk effectively, we talk about the usage of standard deviation. But generally in the credit risk world, we don't talk about standard deviation that effectively. The reason being, if you try to recollect some of the limitations of standard deviation will not be a reliable thing if the data is having too many outliers in it, or if the data is very much skewed. So non-normal kind of a data or non-symmetric kind of the data, if the data is not symmetric, standard deviation as a measure of risk will not have much of a reliability. And what we see in credit risk is every aspect of credit risk, whether you talk about the losses, the distribution of the losses, they are very much asymmetric. The distribution of the default rates is very much asymmetric. Loss given defaults are asymmetric. So because majority of the credit risk related elements are asymmetric, we cannot use standard deviation as a measure of credit risk. Now this is where we are talking about using value at risk, which is expressed as a percentage of exposure at default, being a better measure of variability compared to the standard deviation. And in case of value at risk, we talk about the difference between what is the maximum loss the bank can have at a particular confidence level. So let me quickly draw out a diagram. Now, if this is how the distribution of the losses could be, right? Very skewed kind of stuff. So if this is my mean, which is my expected loss, so this could be my 99% area. This is the 1% area associated with this distribution. So when I'm talking about the 99% area, this is the one. So this is the maximum loss that the bank can have at 99% level of confidence. And this is my expected loss. And what we are saying is the difference between the two will form my unexpected loss. Right? This much is the value at risk for me. So against this particular value at risk, we are talking about that much of capital is very much needed by the bank to really protect itself from the possibility of default. And this capital is what we are calling as economic capital. The amount of capital that is needed by the bank to protect itself from the failure at this level of confidence, at a particular level of confidence, is what we are calling as the economic capital. So which means now if the bank has actually set aside this much of capital based on the value at risk, now the insolvency is coming out only in this small proportion, which means if there is some catastrophic, some extreme loss that is coming up, whose probability is 1 minus the confidence interval, only when such kind of a percentage is going to, in that kind of a percentage where the loss is going to be a low frequency, high severity kind of a loss, only in those cases the bank is going to lose very badly. On all other cases, the bank is being protected by a capital that is the economic capital, which is being used as a backup for protection purpose. So we have already discussed the probability distributions are asymmetric, the loss given defaults are asymmetric, right? Even we could see that the default rates are also highly asymmetric. So the adverse events, they are low frequency but high severity kind of events. They have a very small probability of occurrence, but when they occur, the severity could be much higher. They can affect the overall profit and loss account of the bank very drastically. So when we are trying to go ahead in terms of computation of the economic capital, I need to have a good understanding on the distribution of the return. Otherwise, that 1% could be a very bad decision that I might have taken. The number that I am considering for 1% could be a very pessimistic or very optimistic. So I really need to look at the calculation of the economic capital requires a good identification of the most appropriate probability density function. So that can be a pure closed form distribution going with the various parameters. I can do that way, or I can get into completely numerical simulations like Monte Carlo simulation. Use Monte Carlo simulation to typically identify those extreme events and the kind of severity they have on the profit and loss account. Or I can have kind of discrete probability solutions like scenarios for each of the aspects, and based on them I can go ahead in terms of working out with the unexpected loss and the VAR aspects. A few things that we have to understand in this context: neither the expected loss nor the VAR, they do not consider the portfolio concentration, in what sector majority of the asset classes are lying, because the sum of individual risk is not equal to the portfolio risk. There is some level of diversification that is coming out because of the portfolio. So more and more loans increasing, the more and more loans decreasing, the impact of very few category loans on the overall, more and more diversification obviously will reduce the portfolio risk. This is purely based on less than perfect correlation. The correlation between the various exposures, the lesser and lesser it is, the more and more it is adding to the concept of diversification. So just defining the concentration risk. So especially in a case of a credit portfolio, when I am talking about the borrowers, they are all exposed to common risk factors. So all borrowers are impacted by interest rates. All borrowers impacted by currencies, technological shifts. So where there are common factors which are driving all the borrowers defaulting behaviors, this is what we are calling as a concentration risk. So common factors among all the borrowers, which is leading to either all of them defaulting at the same time or all of them not defaulting. So there is no diversification, especially with respect to these factors. So to what extent the concentration is existing with respect to these factors talks about the concentration risk. So when the concentration risk is very, very high, both the willingness to pay as well as the ability to repay the loan, willingness as well as the ability to repay the interest and the principal will typically go down. And that means large number of counterparties are either unwilling to pay or they don't have the ability to pay, thus resulting in a huge increase in the number of defaults. And especially with respect to some adverse external event, this risk is going to increase more and more. So while assessing, even the concentration risk also needs to be taken into consideration. So one way to overcome this concentration risk, first look at large number of borrowers. So whatever the splitting, don't focus on one single customer or a very few customers with huge exposures to each one of them. So try to diversify to whatever extent is possible with respect to number of borrowers. With respect to each borrower, limit the exposure in terms of amount that is being lent to each of the borrowers, and excessive market shares on the individual customers should typically be reduced so that each customer's exposure is very, very limited. And portfolio should be as much granular as possible, as much diversified as possible, so that the risk of the overall portfolio can be reduced. This whole diversification should be carried out based on a thorough correlation analysis of the various events of default, and based on that the selection of the various customers and the various asset classes need to be considered, and also the change in the credit exposures due to various external events and factors need to be considered thoroughly. And if I have to take all these things into consideration, I have to build full portfolio credit risk models. They measure how much concentration is provided by the individual borrowers, to what extent the individual borrowers are contributing to the overall risk of the party. So by each counterparty, I need to estimate the concentration risk that is brought by each counterparty to the bank, by each transaction to the bank, by each market type to the bank, by each facility type. So I really need to see to what extent the concentration risk is increasing for the bank from each of the counterparties, from each of the transactions, etc. So I am looking at modeling the codependencies across all these areas. And there are different ways. One, I can directly measure the default correlation by looking at the historical correlations of the data, trying to understand the homogeneous group of borrowers, and based on that try to understand what is the level of default correlation between the various groups. And there is an other way where I am going purely based on the asset value correlations. So where I am looking at the probability that the asset values of the two borrowers, both of them taken together, for both of them, what is the probability that their value is falling below their respective outstanding debt? So I am talking about two borrowers A and B. Normally, what is the probability of A defaulting? What is the probability of B defaulting? If I am finding out independently, that's fine. But at a particular point, what is the probability that A is defaulting as well as B is defaulting? Or what is the probability that the value of the assets of A, probability of value of the assets of A are less than the debt of A, and or intersection value of assets of B are less than the debt of B? What is the probability of this situation occurring? That is what we are calling as, based on the asset value correlation, we are trying to model the default codependencies. So the effect of diversification lies in the possibility that the counterparty's value is influenced by the external economic event. When I am using simulation to model the same, I will look at the various external events economic events. Based on that, I am looking at what is the probability that party A is defaulting, what is the probability that the party B is defaulting, and what is the probability that both of them are defaulting simultaneously. Now, once we have understood the concept of concepts of unexpected loss, VAR, and concentration risk, now we are moving on to once I am computing the overall unexpected loss of the portfolio, to what extent I can do an assignment or the distribution of the loss of each of the individual classes to the overall unexpected loss of the portfolio. For that, I want to bring in a few important notation. Right, you take UL as the total unexpected loss of the portfolio, overall portfolio. This is the unexpected loss. I am looking at WI as the weight of the ith loan on the overall portfolio. So the whatever is the amount that you have invested in ith loan divided by the total loan that you have given. That is what is the weight of the ith loan. And I am also looking at the correlation between the ith loan and the overall portfolio, the default correlation. So when the overall portfolio has fallen, whether the value of the ith portfolio also has fallen or has it gone up. So that is what is the correlation between the ith loan in the portfolio versus the overall portfolio. So based on that, we are trying to find out the marginal contribution of the ith loan to the overall portfolio's unexpected loss. And what we are simply saying is take the overall unexpected loss of the portfolio, take a partial derivative of it with respect to the weight. So take a partial derivative of unexpected loss, overall unexpected loss of the portfolio with respect to the weight of that loan, weight of that one single loan in the overall portfolio. So once you find out dou UL by dou WI, multiply that value, which is now this becomes the slope, multiply this slope with WI to get what is the marginal contribution of the ith loan portfolio to the overall ith loan in the portfolio to the overall unexpected loss of the portfolio. But at the same time, we are also saying if I am using the traditional variance covariance approach, then the contribution of the ith loan to the overall portfolio's unexpected loss is taken based on the correlation between the ith loan, the default correlation between the ith loan and the overall portfolio, multiplied by the weight of that loan in the overall portfolio multiplied by the unexpected loss of the portfolio. So here if you see, this part is nothing but the proportion of the proportion of the unexpected loss of the portfolio based on the weight, and that we are multiplying it with the correlation between this particular security and the overall portfolio's correlation. Now if you really see these two things, in both the cases I am talking about ULCI. So it's coming out that dou UL of the portfolio by dou WI multiplied by WI is one method. Then I also have the rho between I and P multiplied by WI into the unexpected loss of the portfolio. When I really look at this mechanism, I could see that the change in the unexpected loss of the portfolio with respect to change in the weight is same as the correlation between the unexpected correlation between the ith loan, the default correlation between the ith loan in the portfolio and the portfolio as a whole multiplied by the unexpected loss of the overall portfolio. right? So this is what we are talking of, and based on this, even the correlation between the two can easily be understood. And based on this, it's also coming out that the beta of the ith loan is simply coming out as the overall contribution divided by the weight. So this is a weight adjusted contribution divided by the unexpected loss of the overall portfolio. So if you see this ULCI by WI, if you bring this here, this is nothing but the correlation multiplied by the unexpected loss. So based on that, it is coming out, the simplification is simply coming out as the correlation between the ith loan in the portfolio multiplied by, correlation between the ith loan in the portfolio and the overall portfolio, which is what we are calling as the beta of the ith loan. And if this number is greater than 1, it means that the marginal risk is adding more than the average risk to the overall portfolio. And if it is lesser than 1, we can say that the marginal risk is adding lesser than the average risk to the overall portfolio. Based on this, the various loans can be selected. So some of them could have a beta of greater than 1, while some of them could have a beta of less than 1. So once I have decided on what kind of portfolios, what kind of risk can be considered, or what kind of loans can be considered by planning on the required amount of beta, then the whole amount of transactions can be identified, so that the overall concentration of the portfolio, which one of them are adding up to the concentration of the portfolio, and which of the loans are really providing diversification benefits with respect to the portfolio. We can really identify those kind of transactions, and based on that, the overall balancing act can very well be taken up. Then the next aspect that is essential in this session is the risk adjusted pricing. We have already discussed that if the value at risk is much higher, then obviously the amount of capital that is needed as a protection against the risk also is much higher. So which is telling me that the economic capital that is typically required as a backup is much higher. And once the economic capital is much higher, which means the profits that the bank has to generate is going to be much higher. So there is a very much a necessity of generating higher profits. So if I am typically looking like the cost of capital that is incurred for the bank, and I multiply it with the value at risk, because that much of amount is actually blocked. So because I am blocking that much, so this is the amount of capital that is simply getting blocked up. So my profit should be much higher than this amount. So it's a kind of a lending cost which has to be incorporated into credit spread. And the lending policies need to be designed more and more stringently based on this particular aspect. And how much is the expected loss? How much is the unexpected loss? Once I do the computations, the difference between these is what will decide what kind of credit strategy that needs to be followed. And any amount that we are talking of as an economic capital, which is the difference between the unexpected and the expected, that needs to be incorporated into the loan pricing itself, because we know that the capital has to be, that much of capital needs to be a backup for the same. So the amount needs to be whatever is the economic capital that has to be considered as a part of the loan pricing policy. Now this is what we are calling as risk-based pricing. It's a kind of a structure for active portfolio risk management. It is integrating all kinds of risks credit risk, market risk, operation risk, and based on that we are trying to arrive at the economic capital, which has to be a kind of a backup against all these risks. And this particular policy will help in terms of formulating the management objectives in terms of the profitability at the business units level. And as a part of the measure for the same, one popular measure which is addressing the risk adjusted pricing is the risk adjusted return on capital, RAROC, very common measurement. It is making an assumption that the value of the different business lines that the bank is having, it is purely dependent on the ability to generate the return. So the return that the business line need to generate should be higher than the cost of capital that is incurred for that particular line. So reward the market risk premium required by the capital corresponding to the amount of risk that it is facing. So the RAROC is purely based on that particular aspect. It is making a clear assumption that at each of the business lines level, I am looking at what is the return that that particular business line is generating. Is it greater than the amount or the return that is expected by the investors of that particular capital for that particular business line? And one of the best ways to make that kind of a measurement is based on the capital asset pricing model, the CAPM. And what it says is the credit must lie on the market risk line, taking into consideration the correlation with the other asset classes. So how much of the credit needs to be provided? It should lie on the risk to return line. So the credit spread have to be in proportion with the market risk premium, RM minus RF, and wherein I am taking the risk premiums associated with all the comparable investment. That is what goes as a part of the RAROC based pricing evaluation. So as a part of the process of computing the RAROC, we are talking about look for what is the target return that the lenders or the investors are willing to accept by investing in the risky activities of the bank. So based on that, the return should be much higher than the threshold of cost of capital, and whatever is that target return on equity that is expected by the equity investors, I want my risk adjusted return on risk adjusted capital should be greater than the target ROE. So in other way, if I have to put it, once I know what is my cost of equity capital, if I subtract it from risk adjusted return on risk adjusted capital, so that is my economic value add. Multiplying it with the economic capital, which is the difference between the unexpected loss and the expected loss, will give me the economic value add. If it is high and positive, obviously that particular investment or that particular lending decision has has performed better. And if it is working out to be negative, it's an indication that that particular decision did not yield the desired result. So the whole intention of risk adjusted pricing is incorporating the various fundamental variables of the value based management approach. So when we are talking about the pricing, we are considering the cost of funding, the expected loss. So these are all the various. So when we are doing the pricing, we should include the cost of funding, where we are talking about the fund fee as well as the spread. Whatever is the expected loss, I am taking out. Allocated economic capital and extra return required by the shareholders. All of them have to be considered. So when all these things are taken into consideration, that is how the pricing has to happen. So that is what when we are computing the RARORAC, we will take the spread and the fees. These are the two things that are contributing to the return. expected loss have to be subtracted. Whatever is the cost of capital which we have got, multiplying it with the economic capital. So the whole thing is divided by the economic capital. So we are expressing it in percentage terms. Even the cost of operations need to be subtracted, and that is what will give me the RAROC, which is expressed as the percentage of economic capital. And this economic capital can very well be used in optimizing the risk return trade-off in the bank portfolios. So that's how we have to look at the risk adjusted pricing. It plays a very important role in terms of evaluating the credit decisions that have been taken. So this is what I wanted to cover as a part of this session. These are the various areas which we have focused in this session. I hope you got a decent amount of understanding about all these various aspects. Any further queries, you can very well give me a call on the number that I have given below, or you can send in an email at the email address provided below. Thanks a lot for listening to this session. Thank you very much.